Welcome to today's webinar on the State of the Banking Transition 2025 report curated by the TPI Global Climate Transition Centre, or TPI Centre for short, at the London School of Economics and Political Science, part of the LSE Global School of Sustainability. My name is Carmen Nuzzo. I'm professor in practice and the executive director of the TPI Centre. The Centre is the academic partner of the Transition Pathway Initiative, or TPI for short, a global asset owner-led initiative supported by asset managers. It has been assessing banks on their progress towards the low-carbon transition since 2023, evaluating a growing sample that currently comprises global major banks as well as banks in emerging markets. Banks play a pivotal role in the low-carbon transition. They influence the pace and the direction of change through the capital that they provide, the clients that they support, and the signals that they send to the wider market. By aligning financial flows with climate goals, banks can help turn ambition into tangible action. This year's State of the Banking Transition Report comes at a particular delicate moment, and there is no secret about that, with ESG approaches increasingly being questioned and the recent dismantling of the Net Zero Banking Alliance raising concerns about the sector's long-term commitment to climate objectives. But against this background, transparent, evidence-based assessments such as the ones that we will discuss today are more essential than ever to inform policy, guide market expectations, and sustain momentum towards a financial system that is net zero aligned. The plan for today is the following. After the presentation of the latest assessment results by my colleague Algirdas Brochard, banking sector lead at the TPI Centre, we will be joined by, in alphabetical order, Torsten Ehlers, principal economist from the Bank for the International Settlements, the Central Bank of Central Banks, as it is often referred to, and Sonja Gibbs, who is Managing Director and Head of Sustainable Finance at the Institute of International Finance, for a panel discussion moderated by Valentin Jahn, Deputy Director, Research and Operations at the TPI Centre. Algirdas and Valentin are the report's co-authors, together with Nelson Diaz-Puerto and Akos Ayagostot, and Professor Simon Dietz, the Centre Research Director. There will be an opportunity for you to ask questions towards the end of the webinar, but you can start posing them throughout the session using the function that you see at the bottom of your screen, and also during the panel discussion. You can also upvote the question that you like the most. Please, I do encourage you to state your name and affiliation when posing your questions. A reminder that this event is recorded and the recording will be available online on transitionpathwayinitiative.org, the TPI website, if technology doesn't fail us. And you can also find the State of the Banking Transition Report on the website or access it through the QR code that you see now on the screen. Finally, let me flag that this is the second report in a series. It is published after the State of the Corporate Transition 2025 that was released last month, and will be followed by the State of the Sovereign Transition 2025 that will be launched in November next month during COP30 from Belém in Brazil. And in this way, we will complete the Centre flagship trilogy. So stay tuned for that. Now, without further ado, let me give the floor to my colleague Algirdas, and thank you for attending the webinar today, and I look forward to a very insightful discussion.
Thank you very much indeed for this introduction, Carmen. So my name is Algirdas Brochard. I am the project lead of the banking project here at the TPI Centre. And for the next 20 minutes or so, I will present you the main finding of our State of the Banking Transition 2025 report. Let me also further echo Carmen's comment and thank my co-author and also a member of the banking team, Nelson Diaz-Puerto and Akos Ayagostot, whose help has been invaluable in putting this report together. So thank you to them both. So let me start, before getting into the results, about a note on the assessment sample. So this year, the TPI Centre has assessed 36 banks on their progress on the low carbon transition. So these are large international banks that have been selected predominantly by asset size and market cap. 26 of these banks were already assessed by the center last year, and we've added 10 more banks this year. As you can see on the slide, we have added 4 Australian banks, 2 banks headquartered in Europe, as well as 2 banks from emerging market and developing economies, 2 banks in Brazil, and 2 banks in India. If you are interested in banks from emerging market and developing economies, we actually do have a special section in our report dedicated to the 4 banks that we've added this year, as well as the 4 Chinese banks that we've assessed last year as well. So I would encourage to look at this section of the report. Another note on the banking project more broadly. So we assess the progress on the low carbon transition in the banking sector on 2 elements. One is the net zero banking assessment framework. So it's a set of 77 questions on which we assess banks yes or no. These are divided into 10 areas, such as banks' decarbonization strategy, the climate governance, or the exposure and emission disclosure. And just to give you a little bit of an idea about the running thread of this framework, it's really to map a bank's path towards net zero. So a bank that would have a commitment, the policy in place would score quite highly on this framework. The second part on which we assess banks is the carbon performance for banks part. So on this, we evaluate whether banks' targets align with international climate commitments. And what we do is we measure the alignment of bank sectoral decarbonization pathways with the real economy benchmarks that we've developed here at the TPI Centre. Once we come to this part of the presentation, I will tell you more about how we actually doing these assessments. But for now, let us start with the key findings of our net zero banking assessment framework. So the main result of our 2025 assessments is that the average share of some indicator met on the framework is around 18%. And if you just remind you what I've just told you a moment ago about the aim of this framework is to assess the readiness of banks towards the net zero transition, you can see that this score is relatively low. However, one thing that is important to note is that they have very important regional variation. So you can see some banks in EMD countries such as China and India scoring relatively low on the framework, but you have banks in Brazil scoring higher than banks in the US, some of which have dropped some of their climate policies earlier this year. Finally, on the right-hand side of the chart, you can see that banks in headquarters in Europe, in Japan, tend to score relatively higher. Most of our framework remain unchanged from last year to this year, which enables us to do year-on-year comparison. And a finding is that 95% of scores have remained unchanged from last year to this year. So if we take these 2% highlighted on this slide, the fact that most scores have remained unchanged and that the average performance is quite low means that overall the banks in our assessment sample have been stalling on their climate policies this year. Nevertheless, we've seen some improvement in disclosures, so notably on target setting methodology, on exposure and emission disclosure, or on oversight of climate risk. However, we've seen some weakening of disclosure in important areas, such as net zero commitment, the financing condition for high emission sectors, or fossil fuel policies. If we go on to the next slide, which I know is a little bit busy, but if you want to take more time to dwell into your finding, I would again encourage you to have a look at our report where we have a similar slides with a little bit more detail and a little bit more context. But let me just highlight a few areas. So the highest scoring areas on our framework are climate governance and exposure and emission disclosure. And the lowest scoring areas are climate policy engagement, so all lobbying indicators, as well as the decarbonization strategy part. This is particularly concerning as the decarbonization policies are the actual transition plans that banks have put in place in order to reach their climate objectives. So the fact that banks are scoring relatively low in this area is worrying for the path of the net zero transition. I would also want to draw your attention to another area, which is climate solution. We've seen in the past couple of years banks putting more and more emphasis on these areas. And in order to understand a little bit more what banks were doing for climate solutions, we've expanded this from 3 sub-indicators last year to 8 this year. And they divided into 2 parts. One is focused on trying to understand how banks set these climate solution targets and the methodological choices that they do. And the other is looked on the disclosure of the financing and impact reporting. Again, if you're interested into these areas, I would really encourage you to have a look at our report where we have a section dedicating to this. Finally, so this is the last slide on the net zero banking assessment. This is the overall scores of the banks that we've assessed this year. And you can see again those regional differences by banks. I would just want to caution this slightly that this is an equal weighting of all sub-indicators, which means that if a bank has a net zero commitment or climate solution target or has fossil fuel policies, this would all have a same weight. So if users are particularly interested into learning about banks' decarbonization strategy or the fossil fuel policy or the deforestation, again, they can head to our website, transitionpathwayinitiative.org/banks, where we can see a breakdown for each of the banks here, score by score, area by area. Now, let's just move on to the carbon performance for banks part. So the carbon performance for banks looks at banks' sectoral decarbonization targets. And so the results of this year assessment is that an overwhelming majority of the banks that we assess do have those sectoral decarbonization targets. So these targets are more common in some sectors than others. So in the oil and gas sectors and automatic manufacturing sectors are quite common, but in other high emission sectors, such as chemicals, diversified mining, and food sectors, banks have set relatively fewer targets. Again, we see quite a large regional divide with banks in the US and Brazil setting fewer targets compared to banks in Europe and Japan. And in the banks that we have assessed, no Chinese banks and no Indian banks have set some sectoral decarbonization target. The additional layer of our carbon performance assessment is after we looked at targets, we look also at alignment with low carbon benchmark. So this is comparing the banks' pathways and seeing if they are on track to on a 1.5 or below 2 degrees decarbonization pathways, for instance. So we can see that roughly a third of the bank's sectoral decarbonization pathways are aligned with low carbon benchmark. Alignment is highest in the electricity utility sectors and lowest in the steel and aluminium sector. Again, the electricity utility sector is really interesting, and we have a little bit more detail on this in the report. So I would encourage you to have a look at that if that is of interest to you. For the year-on-year comparison, we have 9% of alignment scores that have changed compared to last year. And this is mainly due to Wells Fargo canceling its sectoral decarbonization targets and other banks either restating or adding targets covering new sectors. So let me just quickly explain how we do our carbon performance assessment. So if we take the example of this bank here on the slide that has set targets for its electricity utility sector. So on the left-hand side of the slide, you can see some historical emission of the bank's portfolio. And then the red dots that you can see are the bank's targets. So all of the banks that we assess have 2030 targets. And then some have also targets beyond that for 2030 or 2050, for instance. And in the background, we have the pathway, the low carbon pathways that we've developed at the TPI Centre. So if we take the example for 2030, for instance, we can see that the bank's electricity utility pathway is 1.5 aligned. Then we add another dimension on this. So if you look at this is our carbon performance alignment matrix, and if you look at the comparison that we did on the previous slide, this would be for the electricity utilities global, the green dot that we have here. So if we compare it to our pathways, the bank is 1.5 aligned for this sector. But that's not the only thing that we look at. We also look at whether banks, on which business segment and business activities banks have set targets for. Obviously, banks have very different business models, and not all may be material for all banks that we assessed, but we try to be as comprehensive as possible to model the business segment and business activity where setting targets may be relevant for banks. And this carbon performance alignment matrix is available for all of the banks that we assessed in 3 time periods for 2030, 2035, and 2050. Finally, and this is the last slide for me for the carbon performance part. So this is the alignments with low carbon benchmark in 2030 by sectors. And so if you take at the top number, the number above the bar chart, this number represents the number of banks with at least one target per sector. So if we take the airline sector, for instance, we can see that 18 banks have set at least one target covering the sector. So of these 18 targets, 5 are aligned with the 1.5 benchmark. 3 are aligned with below 2 degrees benchmark, 6 are aligned with international pledges, 3 are not aligned, and 1 is unsuitable. Let me just quickly explain the unsuitable disclosures. In order for us to be able to determine temperature alignment, the methodology between the benchmark that we developed at the TPI Centre and the banks have to match. So if, for instance, the banks have set targets on a slightly different sectoral approach, or has used sectoral boundaries, or has used a different methodology, we are then unable to assess the target. Also, you may have seen that I've referred to targets covering a sector. That is also because banks sometimes set one target covering multiple sectors. So for instance, HSBC has a target covering its aluminium and its steel sector. And so you can see that on this picture, the overall banks that we assess, the temperature alignment, except for a few sectors that I mentioned before, the electricity utilities, is quite low. And finally, I will end on saying that after seeing that banks have added quite a significant number of targets in the past 2 years, this year we've seen the rate at which banks have been adding targets for new sector finally slow. I will end there my presentation for this year's assessment results. I'm very looking forward to the Q&A, but once again, if you want to learn more about our research, I would really encourage you to visit our website, transitionpathwayinitiative.org/banks, where you can find our reports and also the methodology that goes with all of these assessments. So with that, let me hand over to our Deputy Director, Valentin Jahn, for the panel. Thank you.
Thank you very much, Algirdas. Here we go. Hi, my name is Valentin Jahn. I am Deputy Director of the Transition Pathway Initiative Centre here at the London School of Economics. In a moment, I will welcome our esteemed panel, but just two reminders relative to what Carmen mentioned at the beginning. Please put your questions in the Q&A at the bottom of your screen. State your name and affiliation. And also, two excellent colleagues, Akash and Nelson, will be answering some of those questions in writing and live. So without further ado, let me introduce the panel. We are joined today by Sonja Gibbs from the Institute of International Finance and Torsten Ehlers from the Bank for International Settlements. Sonja brings deep experience bridging markets, policy, and sustainability with over 20 years in global finance, including as chief equity strategist at Nomura International. Sonja is a leading expert in multi-asset investment strategies and has a strong focus on emerging and frontier markets, capital flows, and ESG investing. At the Institute of International Finance, IIF, she leads policy work on sustainable finance and infrastructure investments. And she's engaging closely with the G20, multilateral institutions, and other international regulators. Torsten Ehlers is a senior economist at the Bank of International Settlements, Office for the Americas. He has extensive experience in global financial systems and sustainable finance. Since joining the BIS in 2011, he has worked on in both Basel and Hong Kong, and from 2021 to 2024 was seconded to the IMF. Torsten has represented the BIS at international forums, including the G20 Sustainable Finance Study Group, and contributed to the Global Policy Dialogue on Green and Sustainable Finance. So with that, very welcome to the panel, and thank you very much for joining us. I want to start with you, Sonja, if I may. The TPI Centre's work that has just been presented, the underlying methodology is informed by investors and obviously assesses the progress that banks are making. Investors and banks are members of the Institute for International Finance. So, given that both on the group that helped us, define what we should look at for banks, but then also the subject of research itself, the banks. What's your reaction to the report, and how do its findings compare with what you typically hear from banks and investors, especially as things are very much in flux at the moment?
Thank you so much, Valentin. That's a great word, in flux at the moment. And congratulations to the Transition Center and the LSE for putting this together. I think it's kind of a beacon of clarity in a world very much in flux. So great reading. I wanted to kind of frame this a little bit with some of the big themes, policy themes for 2025. We've just been through the annual meetings of the IMF, World Bank, and IIF here in Washington, D.C., where we're based. And I wanted to summarize some of that and put it in the context of, what should the world expect from banks in terms of provision of sustainable and transition finance. So one of the first big themes, I think, is this decline in multilateralism. So it's really difficult for policymakers. So, for example, the G20, the G7, or international standard setters like the Financial Stability Board, international regulatory groups like the Basel Committee on Banking Supervision. It's really hard for these groups to make progress on anything to do with climate-related regulation or rules. And this is, as everyone knows, because the US has effectively withdrawn from these discussions. So they're somewhat in limbo. You can't get global consensus on something like this without the US there. So that, I think, in turn, is promoting somewhat of a return of what you might call quasi-standard setters, so kind of a pre-Glasgow world where there were independent groups, academic groups, the United Nations, other sort of like science-based target, these sort of quasi-standard setters, to to this field, and in doing things like setting metrics, measuring alignment, and all of that, as you're doing in this report. The TPI, the framework that you set out is really commendable, but it's also, I think, for the reasons I just outlined, somewhat aspirational, right? It doesn't really, maybe you can't acknowledge the lack of common goals across jurisdictions. So that's one challenge. So when you couple this with this ESG backlash in the US, it's got challenges for transition finance, it really does, and for transition planning. So this greater localization in approach is leading to what we think of as fragmentation in climate policy and regulation. The report highlights this. We've got all this unraveling of voluntary coalitions like the Net Zero Banking Alliance. And I think, our research suggests less policy incentives to go green, as it were, particularly in the US, but other jurisdictions as well. And that means there's less clarity on what the underlying demand for sustainable finance really is. Banks can't create demand for transition finance. Product and development and innovation, it's all proceeding, that's great. But without take up and buy-in, it's very hard to kind of grow transition finance markets. So we've been talking a lot with our global membership about strategy going forward here. So international alignment on things like climate-related policy and regulation and transition planning is very important. We're going to continue to push for that while acknowledging the practical challenges of doing so in this environment. But we're going to put more emphasis on engaging at the local, at the regional and national levels, including with the European Central Bank, Bank of England, with yourselves at TPI and so on, because our members are all based in different jurisdictions. So it means sort of more work for us. And so a little bit less on the global consensus front, a little bit more on the national level. And the underlying goal is to just maximize the potential of private capital to support a pro-growth and low-carbon global economy. And that's kind of political reality. So the focus not so much on mitigation in 2050, which is, of course, at the heart of transition planning, but we see a lot more focus on physical climate risk in the here and now, on resilience, on resilient infrastructure, on the need for adaptation finance. So also the role of insurance, insurance protection gaps, that's critical. So banks have to acknowledge all of this. And areas like blended finance too, that's another big area that can help mobilize private finance. So prudential regulatory barriers in terms of the capital framework and capital requirements are another sort of barrier in the way here. So I think we'll come back to maybe more specifics on the alignment and alignment metrics generally, but I'll just close by saying that's a particular challenge for banks, is that in a fragmented world, it's really hard to get metrics that are not apples to oranges, in the sense that banks are operating in different political environments. So it's difficult to make these comparisons. So again, kudos to you for a fantastic report. And this is going to be a wonderful discussion. Thanks.
Thanks, Sonja. Yeah, lots of points I'm sure we're going to pick up in the Q&A. But maybe to bring you in first, Torsten, in turning to you, so you work at the Bank of International Settlements and you're based in the Americas, in Mexico. And one of the focus sections of our report this year is on emerging markets. And I think Sonja has already been touching on the fact that localization and regionalization of the conversations is something that is occurring at the moment. So I think it's interesting to talk about this topic. And our analysis found that, with some exceptions, the 6 banks that we assessed performed worse than the global average. It should be said that we found at least one example in Brazil that performed at the level of the global average. But having read the report in that section, what's your reaction to this analysis? What challenges are banks specifically facing in emerging markets relative to others?
Thank you, Valentin, and let me also echo Sonja in congratulating you to this excellent report, and also for including EME banks and also making some methodological changes. I'm sure we're going to talk about that as well. But just allow me to start with a disclaimer to say that I'm here in a personal capacity, so the views I'm expressing here are my own and not necessarily those of my employer. I think your analysis of the level of disclosures that that banks and emerging markets are doing, I think is quite apt. But let me also say that, at least in my view, I do believe that banks and emerging markets have come a long way. So you're making the comparison with banks and other very advanced economies, and as you noted, in the case of Brazil, you could even say that the banks you analyze there are basically on par, or maybe even better than some of the other banks in much more developed countries. I think that's overall a positive sign. At the same time, I would also not expect many of the banks in emerging markets to be on the same, or to have the same level of disclosures or focus on some of the issues that you're focusing on in your framework. I guess the first issue for me is that disclosure regimes are different, right, across countries, and particularly in some of the emerging markets that you are analyzing. There is still a different level of disclosures required. So maybe there's something to be said about that. Then, in my personal view, there are also some areas where you wouldn't expect emerging markets in general, and then banks specifically, to be on the same level. So one area, I think that Algirdas presented is, for instance, the decarbonization strategy. So as Sonja already said, right, what banks are doing is kind of a reflection of what firms are doing in the economy, right? You cannot create credit to projects that don't exist. And so some of the implementing these decarbonization strategies, I think in some of the emerging markets is still very difficult. So I wouldn't expect then in turn banks to have strategies that build upon something that may be very difficult to do. And the same, I think, applies to the carbon performance assessment, right? So this is very specific, and if the likelihood that the real sector is not moving fast enough towards certain target is very high, then also I wouldn't expect banks to have a strategy to support that, because it may just simply not be possible. The other area that Sonja had also already highlighted to me would be adaptation. So for instance, in the area of adaptation, which is naturally not covered in your report because your report is about transition, but in the area of adaptation, for instance, I would even expect some of the EME banks to do better if that were covered in the report. So again, I wouldn't see it that negatively. I think it's a good reflection of what is going on, but at the same time, there are a lot of positive signs. And just to quickly conclude my answer to your first question, I still do believe that having good data, understanding what disclosures are in various aspects, including the climate transition, is very important. So analyzing EME banks along these different dimensions, I think is going to be very helpful for investors. Investors want and need that kind of information, at least most of them. And I would say also your methodology basically allows you to be very flexible, right? I mean, investors could pick and choose which indicators they believe are more important in certain jurisdictions than others. And so I think this analysis is very apt and very important.
Thanks, Torsten. And yeah, just to say that it's great to hear you make that last point, because in the group of investors that we worked with in developing the framework were also multilateral development banks who had a big focus on understanding the progress that banks in emerging markets are making, and then also being able to understand where does that sit globally, rather than following a general rule of thumb that maybe there's some catching up. Following some of the comments that you've just made, You've already kind of pointed to the fact that in emerging markets, you have fewer resources, you have potentially other priorities. Adaptation is one of them, but also just general financial stability, credit provision, different, lending costs, etc. So I'm curious from your perspective and looking at it from a 2025 kind of point of view, where does decarbonization sit within the broader envelope of challenges in emerging markets?
I think as you very aptly note in your report, one of the really big issues that Sonja also had mentioned is the issue of the enabling environment, right? There are many different issues that different emerging markets have to address, and these issues are somehow interrelated. So in my mind, the North Star, basically the key goal, is to mobilize investment. And that investment will certainly concentrate, if the business case is there, towards climate positive things like investment in renewable energy. But I think one of the key issues to me is that if we are able to mobilize this investment, a shift towards climate beneficial investment will almost automatically occur if we manage to bring financing costs down for emerging markets. And that is a very complicated issue, obviously. It has to do with many things like risk premia, information asymmetries, which are still very important. But I think the recognition that a lot of the climate beneficial investments, so thinking about renewable energy, for instance, are just slightly more or a lot more capital intensive than other types of investments. So if you manage to bring financing costs down, there will be almost automatically this shift going on, because once capital becomes cheaper, then other types, for instance, of energy production suddenly become extremely competitive, right? And so that to me is kind of the key goal that needs to be achieved. And that will not happen, with, let's say, a single change of policies or a single change of the environment. I mean, that entails so many things, including blended finance, which Sonja had also mentioned. So there are a lot of things in principle that will have to come together. And kind of that is, I think, in short, the main takeaway. But there also, at the same time, I think there is room for innovations in the financing space. So one very, I think, important example here is for instance, a green bond fund that was done by Amundi together with IFC, so also received capital from a development bank, and where banks, which are generally the best place in an economy to overcome information asymmetries, basically take the lead. They give loans, and then they receive the financing in the form of issuing green bonds, and that then becomes an instrument that is very palatable to a lot of investors, also global investors, right? And so that would be my sort of second takeaway, is that whatever we're doing will require a lot of different things, and will also require innovations on the financing side, but maybe also putting in some public sector money from multilateral development banks and the like, and others.
Great, thanks, Torsten. I think sort of zooming out again to from emerging markets to the global level, but focusing or picking up on the topics that you just mentioned, which were the enabling environment and innovation. So coming back to you, Sonja, the IIF sits at the interface of banks, capital markets, and policy, right? So based on the gaps that we've identified in the report, but also, referring to what Torsten has just mentioned on a global level, where do we need more coordination and innovation? How do we get a more enabling environment, in particular, as the general environment is becoming more fragmented? Are there any particular policy measures that you think would be most effective in being complementary to industry-led efforts? Are there any examples that you can point to, or particular recent developments you're excited about? Any insights you can share on that?
No, I think it's a really interesting question. Before I hit that one, can I just make a quick comment on what Torsten said in terms of the global debt problem and emerging markets and what their spending priorities can be in a world where climate risk is way up, and so are other types of spending needs, such as defense and so on. This is just, for a lot of emerging markets, it's just uncharted waters, right? In terms of debt management, debt service costs are higher with higher global rates and so on, and how debt and climate issues interact. It's a big topic, and bringing down financing costs, absolutely critical. So the role of blended finance there. And also, I wanted to stress the new GEMS database. This is the Global Emerging Markets Database, which is all the kind of multilateral and development finance institutions pooling their data so we can get a better sense of what the risks really are in emerging markets. So that's a really important point. I wanted to flag that in what Torsten was saying. In terms of policy and in terms of what we need to create this enabling environment, in the absence of a clear consensus at the international level, G20, FSB, and so on, it is a striking opportunity, and certainly the UK and the Climate Transition Centre, the LSE, the kind of thought leadership community in the UK is probably one of the strongest that there is globally. So it's an opportunity to try to leverage the work that you've been doing to help unite a very fragmented world, while being realistic about what you can do. I also wanted to hit the point about metrics and financed emissions and so on, because banks have come a long way, but at the end of the day, transition planning is very qualitative, right? It's more like business strategy. So to equate things like financed emissions with actual progress, or to use financed emissions as a measure of risk, that's increasingly, I think, coming into question here. And then on risk scenarios, as we saw with the recent NGFS work, there's a lot of questions around how material climate risk really is. And this is inherently political, as we know, but even at a quantitative measurement level, it's controversial. So you've got it both from an individual bank perspective, like the regulator's safety and soundness, how material is it for individual banks, and then systemically for financial stability, for systemic risk, how material is climate risk and on what time frame? Questions that the BIS and others are thinking about quite intensively. So when you think about disclosures, you think about these methodologies, exposure and emissions disclosures, oversight of climate risk, net zero commitment, all these metrics to measure alignments. I mean, there's a lot of challenges around how you measure that, getting everybody to agree on appropriate benchmarks. You can't score and rate banks without agreement on what the benchmarks are. I think we're set for some big challenges around carbon accounting, and that, of course, feeds into disclosures. And finally, I think, portfolio alignment itself, there are some key challenges with the concept. So when you ask questions like, how well are your lobbying activities aligned with 1.5-degree goals? It kind of sidesteps the point of not all jurisdictions are bought into these goals, and therefore the banks that are domiciled there cannot really be either. They're not independent agents of policy. And so the last thing I'd say is that another big theme from the annual meetings a couple of weeks ago here in DC, I think there's a greater acceptance of the concept that there really is going to have to be a two-track transition, right? You have the pursuit of perfection, of green, of getting transition planning perfect and well aligned, and that's absolutely still relevant and still super important, but we also have to be pragmatic. I am reminded of a group of European banking federations and associations that came to visit us during the meetings. And the only question in a meeting that took an hour and a half that came up on climate was rather cynical. It said something like, ESG. So I guess now we're talking about energy security and gas financing. We're not talking about environmental, social, and governance considerations. And it was tongue in cheek, but it also reflected how very political this kind of financing and this kind of policy is.
Thanks, Sonja. And maybe before I open the floor for the Q&A and also invite Algirdas back to the panel, just what you're saying on metrics and sort of and divergence, I think it just rings a bell around the amount of work we've gone through in terms of consultation and working with the investors both in Europe and the US, and continuing that conversation, which is very live, to evolve the framework and make sure that it's fit for purpose, and as well as mentioning or referring back to a point that Torsten made earlier around the fact that the framework is really trying to be modular in the sense that an investor or a user can pick up on different aspects of on particular topics within different, depending on what they're interested in, which might be informed by where they're based. But just basically making a comment around how universities can actually be a great place to have those kinds of conversations in a useful way. I think with that, I would like to open the floor. We have 3 questions in the chat. I think one of them is sort of a duplicate of the other one. So please keep the questions coming. I also obviously have quite a few follow-up questions from this fascinating conversation. But I think, first of all, Algirdas, are you here? Yes, okay. Algirdas, starting maybe with you, bringing you back into the conversation. We have a question from Mireille M. from Climate Bonds Initiative, who is thanking us for the report and your presentation, Algirdas. The question is, I wonder whether regarding carbon performance, if you can comment on the quality of disclosures and data from banks on targets from your experience in producing the report. So a question on quality of underlying data, particularly on carbon performance.
Yep. Thank you, Valentin, and thank you, Mireille, for your question. Let me answer this question by contrasting the sort of sectoral decarbonization targets and the climate solution targets. So the sectoral decarbonization targets really, the way that they took shape was after Glasgow, after the Net Zero Banking Alliance sort of set some guidance that quite a lot of banks followed. That's why all banks that have set a target have set a target for 2030, for instance, and for some sectors. And compared to the climate solution landscape, which in this webinar we talked about financing opportunities, and that's sort of the direction that banks are going on, putting at least more emphasis on. So the sectoral decarbonization targets have a clear link to the real economy, because we're using relatively comparable metrics. So of the 36 banks that we assessed, 28 had a target, at least one target that we could assess. And in some sectors, such as electricity utility, we have a lot, or airlines or aluminium cements. The methodology that banks use to set targets are actually fairly similar. So they use the same sectoral boundaries, they use the same metrics. Of course, the activities that the banks include of this target is primarily focused on lending, with some banks setting additional targets for the capital market activities. But just to say that the targets are sort of set in a way that you understand the progress that the bank is making in the real economy. And the quality of this data is quite good and comparable with our pathways, which enables us to determine the temperature alignment. If we contrast this to the climate solution targets that are incredibly that more and more banks are setting, what we find is that of the 36 banks that we assessed this year, 17 had at least one climate solution financing target. Some banks had multiple targets, but what we found is that most of these targets lacked sector specific, and also the way that banks disclosed sort of progress metric was, often in terms of financing, and the link to the real economy was sort of a little bit more diluted, a little bit more difficult to understand that for sectoral decarbonization targets. Also, there's no universally accepted definition of what a climate solution is. And so what we found is that banks often rely on external taxonomies, such as the EU taxonomies, for instance, but then we'll also sort of add an additional bank-specific lens, which makes comparability very difficult across banks. Finally, we found that some banks, such as Bank of China, was the only bank that fully aligned its green financing activities with a government-established taxonomy, which should be good for comparability. However, in the Chinese taxonomy, green coal is considered a climate solution, which may not necessarily be the case in other jurisdictions. So just to say to wrap up on this answer, yes, the data on sectoral decarbonization target is quite good and comparable across banks. And now for climate solution, we look forward to having perhaps additional metrics in the coming years that enable us greater comparability across banks.
Thanks, Algirdas. And also great to see there are more and more questions coming in. Also, just for the rest of the audience, please upvote the questions that you find most interesting. Otherwise, I will just go through them and pick what I please. So we have a question for Torsten, but I think it's actually to both of you around enforcement of different relative to commitments, etc., that have been made. So can either one of you answer the following question? How are supervisors ensuring that such reversals, i.e. taking down, let's say, a net zero commitment, are accompanied by transparent revised risk disclosures rather than leaving the market with a misleading picture of exposure? Torsten, do you want to take a stab at that?
Yeah, I could say something quite general about this. So I think it's very important to unpack the many different issues that are contained in this question. So whether risks are material or not, it is, of course, when it relates to disclosures, is something that is directly related to the institution itself, right? So it's not a question of whether climate risk in general are material. It's a question of whether certain types of risk are material for that very specific institution, okay? And for instance, if you look at what a lot of central banks have been very engaged in, I think, to really come up with a bottom-up analysis on how material these risks are, even for individual banks based on the very granular data that they have, there is a huge variation. Okay, so that I would say is the first main takeaway from that kind of analysis. So assuming that it's material for every institution, I think is not the right way to think about this. The right way to think about it is that different institutions will have different exposures. They also take different mitigating measures. So then the potential impact will be very different. Okay, so and this different impact may well change over time. You know, that would require a very detailed analysis of whether that is the case or not. A net zero commitment has nothing to do with risk exposures, right? So that is again a different thing. That, you know, not following up on that may be something that investors don't like, but it's not something that, you know, regulators have anything to do with, right? That's a business decision by a bank. And I think also what I would like to emphasize is that at least in the central banking world, I think right now, in particular in the last 2 to 3 years, I would say, there has been a lot of progress in analyzing risk exposures. However, as Sonja noted already, we are still not there. I think that's another thing that we really need to recognize. You know, there are still many questions as to how we should do this exactly. You know, what the type of risks are that we're analyzing. There's also this notion that, you know, for instance, physical climate risk are definitely material for everybody. It's also not you know, appropriate, because we need to do the exact analysis, and I think some of the analysis, very good analysis that central banks have done, shows that physical risk exposures, for instance, are very different across banks. Some banks have very limited physical risk exposures because these risks tend to materialize in geographically confined areas. And if you're not exposed to that area, then obviously your exposure is relatively smaller. But I think on a positive note, you know, the work is being done, even if we are not there yet. But there is definitely a lot of work ongoing in that department.
All right. Thank you, Torsten. Sorry,
can I just come in on that one quickly?
Yes, please.
If you think about the role of supervisors and the mandate of supervisors, that gets to the heart of what the challenge is, right? If we don't agree on what supervisors' mandates are internationally, then you don't have a level playing field. You have supervisors in one jurisdiction being much more concerned about things like the accuracy of disclosures and that they not be misleading, other jurisdictions not. We don't agree on how to measure the impact either, so that again takes away our benchmark. And I think it's important to note that in terms of climate disclosure, we have no agreement on whether this should be treated, climate risk should be a separate risk from things like operational credit, liquidity risk, or sort of reported in the context of these other risks. So as you see, the US SEC has had to take down all of its kind of climate specific rules. So I think those present three challenges for what can supervisors do to ensure appropriate disclosure.
Thanks, Sonja. We have one more. So we are at 58. So in the spirit of trying to wrap up in time, I will have a call to action for all of you as a good moderator. But just quickly, a question for you, Sonja, if you can just respond in a few words, hopefully. A question from Michael Williams at Imperial and also Transition Finance Council. My question is for Sonja. To what extent is transition finance being viewed as a competitive advantage for financial institutions? And how can this be used to help in achieving their own transition targets? So any quick thoughts on that would be very appreciated.
Yeah, and it brings up a super good point. Transition planning is encompassing risk and opportunity. So the opportunity, you know, ignoring an opportunity can also be a risk in that sense. So this question about transition opportunities is very live, especially in the adaptation space, in the resilience space. Torsten mentioned the blended finance. You've got the whole critical minerals debate and supply chain resilience. All of these are factors for competition. So yeah, it's a very good question, and I think actually the focus is shifting towards seeing it as a point of competition, competitive advantage. So.
Thanks, Sonja. All right, so in the spirit of wrapping up in time, I want to thank all of you. I will ask every one of you for a quick call to action in a second. I just want to say also a big thank you to the team at TPI from me for putting this report together. I also want to thank the audience for your time and joining us today. Please stay engaged. As Carmen mentioned, our next publication will be the final one in our trilogy of reports, and it will be about the state of transition for sovereigns, which will be marked by a launch event on the 11th of November in Belém. And we will also be trying to answer the questions that we haven't been able to get to in writing as well. With that, a quick call to action from you, Sonja, then Torsten, and then maybe Algirdas.
Okay, be pragmatic, acknowledge how unique the positions of individual global banks are in the economy, the qualitative nature of transition plans, and the political push for growth and competitiveness, as opposed to what they see as overregulation. So be hopeful, commend progress rather than sort of shaming and finger pointing, build up progress even if it's not using the same yardstick, and be very thoughtful about things like the use of the capital framework or penalties for banks, because that really plays into the whole focus on competitiveness, which is everywhere around the world. We can't let the two be conflated like that. It's not anti-competitive. Transition is not anti-competitive.
Thanks, Sonja. Torsten.
Yeah, I have two calls for action. So one is for you guys, because I think at the end of the day we need to scale up green investment to manage the climate transition, and for that we need to provide transparent, very clear, very simple information to investors. And I think you guys are part of that puzzle, and call for action is continue the good work. Keep it as simple as it is. The second call for action is related to policies in emerging markets. So unsurprisingly, there are still things to be done, but the call for action is, let's work together to make it happen and to create a situation where emerging markets are really an interesting and competitive destination for investments.
Thanks, Torsten. We obviously like to hear that on the first call to action. Over to you, Algirdas, really quick, and then we'll wrap it up.
Really quick, we're at the TPI Global Climate Transition Center, so we always want to have the entities we assess do more for the climate transition. And as a sort of intermediate step, we welcome consistent and greater disclosure. So that's really important to being able to compare entities with each other. So that would be my two quick call for action.
Awesome. Thank you, everyone. And I will then close this webinar. Thank you very much for joining us.
Thank you.
Thank you.